The information in this podcast is current on the day of recording. It is general advice only, does not take your personal situation into account, and may not be suitable for you.
Hi everybody, my name's John Addis. I'm the founder and editor of Intelligent Investor. I have with me here today Graham Witcomb from Canada. What time is it there, Graham?
Hi, John. It's 8:13 p.m.
That is dedication. And also we have our new analyst, Gus Donohoo. How are you doing, Gus?
I'm very well, thank you.
That's good. We're going to kick things off with a news item today. I haven't spoken to you about this before, so it's a shock, but not too shocking. Not in the media industry anyway. So I don't know if you've been following what's been going on at Nine Entertainment, where the head of Channel 9's news and current affairs operation, Darren Wick, has been credibly accused of sexual harassment for over 10 years now. And the company has been asked whether they have used non-disclosure agreements to silence women who have made these complaints. And this is the reply from the Nine CEO, who, let me just get his name here, Mike Sneesby, who sent an email to staff, I think it was on last week, was it, or the beginning of this week? And he said, as CEO at Nine, I have never signed any NDAs for any employee relating to a complaint or behavioural issue. In particular, I did not sign any NDAs with Nine staff in relation to Darren Wick's alleged behaviour. Do you think that's a red flag?
Well, it's interesting that he's never signed one, but that doesn't mean that the General Counsel hasn't signed one.
Right.
There's a lot of omission in that statement, I would say.
Yeah, I think it's utterly misleading. A CEO would never sign a non-disclosure agreement. It just seems utterly evasive behaviour. And he's not really answering the question, which is quite straightforward. What do you think, Graham?
So the question was just whether he had signed one related to these...
No, has Nine gagged female employees by getting them to sign non-disclosure agreements?
Okay, well then, yeah, it sounds like that the kind of Bill Clinton approach where you could slightly change the interpretation of the question to answer to suit your answer a bit. So.
Yeah. For me, this is a bit of a red flag for shareholders in Nine because it's deliberate dodging and weaving, and he is CEO of a news organisation which is meant to report the truth, and he's clearly being evasive, not just with his readers, and but also his staff. And I think it just shows a real insensitivity towards what this business does. The journalists are going to pick this up straight away and just wonder who it is who is in charge of their organisation. I think it's quite shocking.
Yeah, and it's a bit silly because they'll be able to find the truth out pretty quickly. Yeah, so it's not as if he can hide it indefinitely.
That's right. And I know a lot of people in media, and the idea that this was a secret, and it's possible the board didn't know, but if this has been going on for 10 years, it seems incredible to me that it was not common knowledge. It certainly was common knowledge among the women when they went to social functions and stuff, from what the reports are saying. Anyway, I think things like this do give you an indication of the kind of quality of the person that is running an organisation, and this does not speak very highly about this person at all. I'd be quite worried about them.
It's interesting to me that it's taken this long to sort of come out to the surface, with all of the sort of Me Too stuff following Harvey Weinstein. I was in the media in Hollywood when all of that was breaking, but everyone knew about it. It was so widely known across the industry that that the dude was super creepy, that really bad things had happened to women that had kind of gotten on the wrong side of him. Yeah. I'm very skeptical of anyone. I mean, surely there's going to be some people who do have honest ignorance, but in that city at that time, everyone in the industry had heard bad stories about that individual.
And the only way that is kept quiet to the general population is usually through NDAs. That's the mechanism how it doesn't go into the mainstream.
It's exactly right. And they get used as kind of a cudgel to really sort of, suppress conversation.
All right, Gus. Let's move along to Lifestyle Communities.
Yes, indeed.
Which is a property developer of sorts I am the target audience for them, apparently. People who are downsizing, their kids have left home. In my situation, I might say to that, if only. I've still got one left, and it's quite nice having him hang around. But, in a few years or so, I might be in a position to say, well, do I need a 4-bedroom house? Do I want all my money tied up in these houses? I could do something else with it. I could spend it or invest it even more in stocks. Give me the pitch for lifestyle communities, Angus.
I mean, I think the pitch for you would be, let's turn your assets into cash. This is a business. It's going to take your nice house that you've got, sell that, buy into a community where you can hang out with your friends of a certain age and
play all the lawn bowls you can
the lawn bowls. There's probably a snooker table. There's a gym.
Weekly bingo.
You're not really selling it.
And what you will get in exchange for that is you will get a 99-year lease on a house. You will own the house, but it's on a piece of land that's on a 99-year lease. You get a 20% discount on the purchase price, which you'll then it's a balloon payment that you're going to pay back at the end.
And the end is either when I die or move out.
When you die or are moved into a home.
Mm-hmm.
And then you will be paying a monthly fee, which is going to be about 20% of your pension or 40% of your pension or something, but calibrated if you're on the age pension, right, calibrated to be a sort of fixed percentage of the age pension that you pay for the services of living there. And in that sale of your house and this move, because the property you're moving into is a demountable, it's a bit like a caravan.
Right.
You're not going to pay you're not going to pay stamp duty, and you're not going to pay council rate. So it's a very cost-effective way to turn your family home into a bit more liquid cash.
Okay. From what you've explained there, the last two things are the only things that sound really attractive about it. But let's assume that I go ahead and do this and then start to, as part of my due diligence, I start looking at the company's accounts. What is it do you think I'd find? Because you've spent quite a long time looking through it. What are the things that stand out to you?
It's a pretty confusing picture because of the fact that you're doing property development. So they're paying forward lots of cash. They're spending lots and lots of money building, buying land, building property on it. But it's a slow process. So your profit and loss statement doesn't really connect very well to your cash flow statement. It's very confusing to try to sort of piece together where the flows of cash are going. And then it gets even more confusing because the profit gets adjusted by this thing called a fair value adjustment. And so it's taking into account...
That's a source of a lot of trouble in a lot of companies, I think.
I suspect it might be. I found it was originally it's part of the rules. So under the IFRS, the accounting rules, the companies do need to report changes in the value of assets and run it through the run it through the profit and loss statement. So I think the thinking originally in making the adjustment was so that making this the rule was what you would have was companies would sit there with an asset that's increasing in value on their balance sheet, and then suddenly they sell it and they would count it as revenue in a sort of, potentially dishonest way. So I think the rules were designed to address that. But what's ended up happening is some companies are able to use these adjustments to show that they've been profitable over a long period of time when in fact they maybe have been, but they're sort of banking increases in the value of an asset as revenue when taking something to market or what its price is priced out on paper are very, very different equations to my mind.
And Graham, in your experience, when you have a situation as Angus has found, where you've got one company among, I think it's 5 or 6 listed companies, Angus, where the adjustments to revaluations cover quite a wide range, and you I think you'd say that lifestyle was probably at the top end of that range. And obviously the properties are different. The land has different value. You can see why there might be variations as to the adjustments that they might make to their portfolios. But the extent of the range is quite surprising. How does an investor deal with those kinds of discrepancies, Graham, when effectively you can get an independent valuer that's often paid by the company and the company has latitude to revalue its assets? How does an investor really understand what those things mean and whether they're fair value or not?
Well, I think the right approach is to first of all just take it as a red flag that needs further investigation. I don't think that just because it's at the top of the range, that doesn't guarantee that it's doing anything wrong. It just means that it's a bit of an outlier and you need to kind of dig in more about what it is doing, which is exactly what Angus has done. So from there, I think that, if you find something that's odd, it should just be a signal to kind of get to the reason why. And I wouldn't put a lot of faith in kind of what management say or even those independent valuations, because I found in other companies that they can tend to be, just rubbish, basically. They're just what the management want anyway. So, I don't have a lot of faith in those, but you can do other kinds of comparisons or look at if you have access to the assets on an individual level, you can go and value those yourself and see what else is around and what they're being valued at. Just kind of take it from a bottom-up approach rather than just listening to management and reading what the kind of overall number is.
Yeah. So Angus, when you concluded your research, you basically said this is not really for us. But there's a lot of enthusiasm for this company. The stock price has done pretty well over the last year or so. Why do you think that is? Where is this enthusiasm coming from?
Well, they've grown quite tremendously, right? So back in 2009, they had less than 100 houses, and it's $27 million in property assets. They've now got nearly 4,000 homes and almost $1 billion in property assets. So it's grown very quickly. It has. I think one of the things that does make me cautious, and that sort of ties back to that fair value adjustments thing, is that, if you just sort of take the numbers as they're kind of reported, this has looked really profitable every year. But if you were to strip those fair value adjustments out, in the last 10 years, 5 of those years haven't been profitable, or wouldn't have been profitable but for these adjustments. So the way that I sort of thought about this is, well, how do we kind of compare this to other companies in the industry? And over the last 10 years, every single year, the adjustments have been positive. So most competitors, at least 1 or 2 years, they've had an adjustment that's actually reduced the value of the assets. For this company in particular, every year for 10 years, it's been a positive adjustment, and the average adjustment over those 10 years has been 36% of their sales. The next competitor was only 10% of the sales. So, there was an anomalously high positive, effect from these adjustments. And I think that on paper, if you sort of look at one of the things that's so tricky with these adjustments too is a lot of the financial metrics that you might use to look at a company, like the return on equity, for example, those adjustments affect both the numerator and the denominator, because the retained earnings of the business are also affected, and then the net income's affected, and so it's kind of like there's quite a bit of sort of having cake and eating it too with these things, I find.
So that sounds like a good reason to avoid to me, and that was your conclusion as well, Angus. Let's now move on to one of Graham's stocks, which I think, Graham, we first wrote this up in, let me have a look, 2015. We upgraded it to a buy at a price of $1.80 in August 2015. The share price.
This is Gentrack, everyone.
This is Gentrack. Yeah, I was coming to that, Graham.
I saw your punchline. I thought you just started talking about it, assuming that we'd mentioned it. Oh, damn! I ruined it for you.
That's all right. It got up to about $7 in within about 3 years. So it's a really successful recommendation in a short space of time. And then it just plummeted back down below our buy price in 2020 and sort of bumbled along At which point you upgraded it. I think most recently we had it on the buy list this week. 134, was that right? No, it's a little bit higher than that.
Not this week. Yeah.
152 in 2022, and now it's all the way back up again, up around $9. Tell us about Gentrack, Graham, because it's been an astonishing performer in a short space of time.
Yeah, it's been it's just been an interesting company to cover because we've had two bites at the same cake. Yeah. But interestingly, what's changed over the past 18 months, the first price rise.
I'm going to do. Sorry, Graham, to interrupt you, but I'm going to do to you what you just did to me. What does Gentrack do, Graham?
Well, Gentrack, its main thing is to supply billing software to utility companies. So the gas, water, electricity companies, they have to send out their bills to everyone, and the odds are that you've at some point received a bill from Gentrack because they cover so many different businesses. But that's its main business. And then it also has a side business, a smaller division, which runs airport software. On most of the airports that you would have been to locally, actually, are run on Gentrack software in terms of the panels that you see your flight data appear on. So those screens, yeah. So they've got those two businesses running. But interestingly, in 2016 or so, they started changing their business model to a SaaS-based model where they were doing it all through the cloud instead of kind of on-premises software.
Right. Yeah.
And that seems to have triggered something with the public's mind over the past kind of 2 years in particular, where it's just been able. So we actually criticized it, Gentrack, after it did make that change, with the argument that its strongest competitive advantage was that its customers were kind of locked into its software. Once it was, they were using it, like they were not going anywhere. It had lost hardly any customers because of the difficulty of switching. But anyway, moving over to cloud-based software, that's lowered significantly the customer captivity, that it's much easier to port between different providers.
Right.
The benefit of that has actually shown up over the past couple of years where they've been able to win lots of new business. So previously the customers were ultra locked in, which meant that the whole industry was fairly stagnant. Whereas this shift over to cloud-based software has allowed Gentrack to win a ton of new customers, mainly retailers. Yeah.
So is that because, I mean, it's probably a number of reasons, but I can imagine a situation where they're confident about their product being the best in market.
Yeah.
In which case they're going to switch more customers to them than away from them. I can understand that. Is that part of it? Is there something else going on there as well?
Yeah, definitely. They've had such an incredible run with customer acquisition over the past couple of years that I think that does just help. There's a lot of momentum behind it, that it just helps sell the next customer when you've added a bunch of really big ones. So yeah, I think that momentum can carry on for quite a while, but a lot of tech companies find that the momentum runs out, and then we'll see the other side to that lower customer captivity, where I think compared to Hansen, which is one of its largest competitors, but it still does mainly on-premises software, that it'll have much more volatile earnings over the next decade than Hansen, which has still has that kind of locked-in customer base.
Do you think, though, that the cultural change needed to do, and I think we saw this at Microsoft, you might want to comment on that, Gus, but when you switch to a SaaS model, because there are no upgrades, you're not re-signing contracts, you're just getting people to pay another fee every month, a much lower fee. Not only does that lower the switching costs, but maybe it changes the culture a bit as well, where you say, well, we've got customers that we can lose next month. We need to keep pushing out new features, keep improving the speed, increasing security, doing all of the things that these companies might want, where there isn't that incentive when you lock somebody in for 4 years and the customer comes back and say, well, can you do this? And say, yeah, sure, that's going to cost you $950,000 to rewrite your software and give you a custom feature.
Yeah.
Do you think that could change things as well?
I can imagine it would. I do think that Gentrack would then be more focused on constantly upgrading things, providing more features. But there is There is a benefit also to the on-premises version, which is Hansen is doing mostly bespoke products. So it's doing only what the customer wants. Whereas Gentrack's putting out a product that is trying to satisfy everyone. So yeah, you've just got two different models. And I think there's a place in this industry for both of them. The larger utilities tend to still use on-premises software. The smaller retailers have switched pretty quickly over to cloud-based software.
And how is it Australia and New Zealand end up with these two sort of globally significant companies in these areas?
Yeah, I honestly don't know. Just a bit of luck, I guess. There's probably an easier time in talent acquisition because you're going to have competitors around that have already trained up their staff on similar products. Mm-hmm. But yeah, I'm not quite sure why Australia has these two. There is a lot more competition out there than just the two of them. So I think I think Australia and New Zealand hit above their weight in the industry, but you've still got giants that are the American businesses running a lot of America on it.
Let's talk about valuation then, Graham, because we're not selling out despite having made good money on this stock. But you do, your article inferred that, or stated explicitly, that we do prefer Hansen at this point. Is that just because of the relative valuation? Gentrack does seem quite expensive, even though it's growing quickly.
Yeah, the trouble really is down to the valuation. I've got no problem with Gentrack. I think it's actually done a marvelous job turning itself around over the past few years, because if you'd gone back kind of 4 years ago, it was in a lot shakier position. So yeah, hats off to Gentrack for really pulling itself up. But ultimately, the valuation already encompasses a lot of its growth for the next decade. So Hansen has almost 3 times the profit and revenue of Gentrack, and yet they're trading on pretty similar valuations in terms of their market caps. It's not off by a huge amount. So the way I think of it is that Gentrack is trying to get to Hansen's size, and yet you're already paying Hansen's price for it. You're getting 3 times more for the same share price, basically, with Hansen. Okay. Which unless you feel that Hansen is somehow doomed, which I don't think it is, because Gentrack's going to completely overtake the industry and every possible utility will be switching to it instead of Hansen, then there might be a case for favouring Gentrack over it. In fact, there certainly would be a case for favouring Gentrack, but that doesn't seem to be the case. Hansen's still growing. Hansen still has an excellent set of staff. It's got a much more diversified revenue base, and so is also much more stable because of the change in business or the different business model. So it's not as if it's, I think it's a bit of an ugly duckling at the moment because Gentrack's suddenly got all the glamour around it. But in terms of valuation, Hansen wins hands down, in my opinion.
Gus, do you have any views on this switch from contract-based agreements for software to a SaaS model? We've made good money on companies like RPM Global. Xero obviously did well when it switched over to monthly payments and took MYOB, took them on and generally beat them, I think. Do you have any views on what kind of model you would prefer as an investor?
I mean, it's certainly been something that's made or broken businesses in, the last decade, last 15 years.
I think it probably saved Microsoft.
Yeah, I think it did. And it's sort of one of the things that's interesting about it is it's actually reflects such a big organizational change, because your legacy software companies because generally I associate that more older licensing model as it's kind of connected more to legacy businesses. Most have moved to that subscription base now, and it reflects a tempo of development inside the software company itself. So previously, if you were only updating the software every 2 years, there was a really different way that the cadence of the organization had to run. Whereas if it's now a subscription where you're pushing out updates every week or every year, internally in the organization, it's got to have a really different flow. And some companies really struggled with that transition because, you have employees who'd been there for 20 years and they had a very particular way of working. And an example of where it sort of hasn't really gone so well, though, the stock's doing better than it was SAP. And one of the things that was interesting there was there was anarchy in the SAP customer base at one point, because these companies that spent a fortune, because similarly to SAP, similarly, it's often very customized work. A company spends a fortune integrating this very complex system, and then SAP kind of tried to come out and say, well, we're not going to continue supporting that license. They sort of put in an end date to it, and that was sort of met with fury, and they actually had to sort of back down on some of those assertions that they were going to do that. But I think that subscription model, if you can be getting that regular income, it just is going to look, it's just sort of more attractive. But I don't think it necessarily is guaranteed that it creates a better lock on the customer.
No. I mean, I think that's Graham's point, isn't it, about the fact that having customers there on contract and writing customized software for them, where the software is absolutely crucial to running their businesses, it's not a bad place to be either.
Yeah, I totally agree.
Business segment, so it's not a bad place. Okay, well let's move on to a third topic, which has not so much to do with stocks, but more about the macro environment. And we decided we were going to talk about the new Cold War, which was something I wrote at the end of last week. I think it'd be interesting to discuss because Graham lives in North America, and Gus has lived in the US for a long time. I suppose reading about China is one of my hobbies, and I've never been there, but I do like reading about China. And I just find this situation slightly alarming, but incredibly fascinating, because for the last, 50 years, I think we've lived with a general acceptance based on the idea that free trade is generally good, and we can associate free trade with liberal democracies. And that has been incredibly successful, mainly in China, where it's pulled about 800 million people out of poverty, but also elsewhere around the world. It's had its victims, especially in areas in the West that have had manufacturing sectors, but it's generally been accepted that free trade is synonymous with economic growth and prosperity. And even though that prosperity hasn't been shared that well, I do feel that the last 50 years we've made pretty good progress in some of humanity's greatest challenges, especially in Asia, where life expectancy has increased, incomes have increased. We have a vast middle class now that we just didn't have 50 years ago. But that philosophy that brought that about seems to be at an end. We seem to be facing a new trade war, and I think maybe there's a bigger picture behind there. So who wants to take the first stab at this?
Sounds like you've taken the stab.
Yeah, I've stabbed.
We're just finishing it off.
That's right. Who wants to make the killer blow? Well, look, do you guys agree with that perspective? Because there are a number of different angles you could come at this.
Yeah, I hope that it doesn't. I think, like you said, it does seem to be going in that direction, but it just seems so much more rational to have free trade to me for a lot of things anyway. And so I hope that we move back in that direction and that the politicians eventually figure it out, and this is all just a bit of posturing, but the benefit is on both sides for China and the rest of the world. So I'd like to think that eventually everyone kind of comes to the table and does what's best for everyone, but you just never know with politicians, particularly in dictatorships. It can be very different.
Yeah, I fear I'm fairly pessimistic on this subject in that, I think this has been going on for years, really, these sort of increasing trade restrictions, a lot of it tech related. But, this escalation, the recent one of 100% tariffs on Chinese EVs, it's just, and you've got a really active attempt by the US at the moment to block China's capacity to develop cutting edge technologies especially in semiconductors. It's going to be with just, if you're looking on the horizon of this is happening under Biden, and then your alternative in the next election is going to be Trump, who brought in all sorts of tariffs. I think in the foreseeable future, this is probably going to get quite a bit worse. And just hopefully it remains as a Cold War and doesn't get hot, because I think that would be extraordinarily catastrophic.
Gus, when we spoke about this, you mentioned the Peloponnesian Wars. And I know that might seem like a completely irrelevant historical analogy, but it isn't really. This I think you were referring to was a Thucydides trap, where Thucydides was, I think, acknowledged as the first historian who examined the Peloponnesian Wars, and I can't remember whether it was Athens or Sparta, which was the prevalent power at the time, but it was under threat. And what the Thucydides trap was, which is by an academic, I forget his name now, at Stanford, I think, who said that in most cases, the ability to evade war is determined not by the actions of the rising power, but by the power that occupies the primary position and their capacity to move to allow a rising power to rise further. Would you see that interpretation through these recent events?
I mean, I think there's certainly a case that can be made for it. That essentially Thucydides, he thought that he says that the conflict was inevitable. So Sparta was sort of a rising power. Athens had its own empire, and there was just this sort of inevitability that they would kind of come into conflict with each other. I did read that book a long time ago, and I don't mind that, I wouldn't profess to be an expert on it, but I think that there's certainly a lot of indicators that we might go to war, but we do live in a nuclear armed world, and it's hard to imagine that at some level a lesson from the last, say, 50 years has been that there is some amount of rationality in policymakers, and you sort of would hope that it kind of doesn't get there. But if you do look at one of the things that's so interesting about this is that it's crystallizing around the chip industry. And that is kind of this real flashpoint where the most cutting edge technologies are so instrumental in this conflict. And most of your the vast majority of your cutting edge logic manufacturing occurs in Korea, and Seoul is in artillery range of North Korea, or in Taiwan. And a chip fab is not going to survive a bombing. It's not going to survive a war. They're very fragile industries, industrial factories. So I think that it's. I hope it's not inevitable. There's an interesting scholar that I remember I listened to a podcast a while ago who was really saying that it's better to think about this through the lens of the long conflict, the 30 Years' War that occurred between France and the UK. Yeah. That it's more like that than this kind of inevitable clash of two giant empires. But time will tell, I suppose.
Yeah. I think it's a risk that people aren't. For me, I think people see this purely in trade war terms, but I think it's more significant than that. What this means for investors, who knows? We just don't. I don't think we want to turn our backs on free trade. We saw what happened in the 1920s and 30s when that did happen. The world turned away from global trade and became very protectionist. I wouldn't want to see that again. I think if it did happen, it would be disastrous for a country like Australia, which is so export and import dependent. That's all quite heavy. Let's move on to something a little bit lighter.
Jelly beans.
Chili beans. Peppermint toothpaste. We do a lot of reading, a lot of watching, a lot of listening. I think it'd be nice for members to hear one or two recommendations for either finance-related stuff or stuff that gives you a little bit of break from finance but is entertaining and interesting. So, Graham, what have you got?
Well, I think it was entertaining. It's not necessarily less heavy, but I got through recently the Reith lectures with Jonathan Sumption, the Supreme Court judge in the UK, and he was talking about law's expanding empire, which was essentially that we're becoming more and more dependent on the law because we're distrusting politics too much. Was kind of his underlying argument, and then saying that that's actually a really bad state. We need to be working more towards the idea that the law doesn't have all the answers and it can't solve everything. So at the moment, everyone's turned to all of the cases with Donald Trump in the Supreme Court at the moment over in the US, but that you don't want everything to swing on just these 9 justices, what their decisions are. It's better to have public decision making through politics, and there's a better negotiation and then more buy-in by the public. So
Yes.
yeah, he was defending the politicians and saying we need to make sure we do leave space for politicians and not just look to the law for all of the answers, because it doesn't bring a lot of consensus. It just kind of lays out the rules that the politicians have made.
Yeah. Or in some cases, not even that.
Yeah.
Gus, what have you got?
I've been reading something called Grand Horizontales, which is
an old classic.
Is it in Spanish?
But it's about the French Second Empire. So that was when Napoleon III arose, who was Napoleon's nephew. But in that time, you had this extraordinary period of kind of I guess in a way, the Kim Kardashians of the day were these courtesans. And at the time...
They would really resent that comparison, I'm sure.
Well, yeah, that's probably true. But women had no independence in that time. And so the influences almost were these women who were quite remarkable individuals, and they sort of created these artistic salons around them. And the reason I got interested in this is if you go to Paris on the Champs-Élysées, there's one giant mansion left, one of the original kind of houses from sort of that period. The rest have been turned into larger buildings, and it's absolutely spectacular. There's extraordinary statues in it and these extraordinary staircases, and it's called the Hotel de la Pava. And it was this woman who was one of these famous courtesans, and she got a royal title, and she was the talk of Paris the entire time. That's more of the illusion I was trying to make to the modern day. But it was just it's a really fascinating book because women had so few options there for social mobility, and these women were clearly very intelligent, very successful. Some of them were quite, I don't want to say cunning, but they leveraged the opportunities that were there for them in really interesting ways. It's been an absolutely fascinating book, and just learning about France in that time.
Yeah. I think we've all just confirmed what a bunch of weirdos we are with our recommendations.
We haven't got to yours yet, John. What's yours?
Well, you guys mentioned Shogun. I thought you were going to talk about that.
I love that.
I really want to watch that.
You got to, yeah.
I read the book in the 1980s by James Clavell. I absolutely loved it. Didn't think it would be turned into a TV series. I think this is the second or third one. It's not the first. So I'm going to be watching that. I'm looking forward to watching that. I'm going to recommend a book called, checks notes, Breaking Twitter by Ben Mesrich, who's a well-known magazine journalist, and I think he's written for the Times as well. It's about the story of Musk's takeover of Twitter. I have to say, I came out of that book feeling quite sorry for him. He just doesn't know how to relate to people. It must be quite lonely being the richest man in the world and Elon Musk. There's some stories in there that are absolutely abominable, the way that they treated people, the disregard that they had for the business and the advertisers and the staff, and the sort of people that the yes man that he surrounded himself, that just sort of exacerbated his worst characteristics. I think it makes, from an investment point of view, it makes the case that, if you've got a brilliant engineer, well, get them to do brilliant engineering. Don't get them to manage staff. And if you've got a brilliant manager, then get them to manage staff. But once you get to a point where Musk has been lionized and feted by so many people, they come to believe their own brilliance and just end up destroying everything. And that's what's happened at Twitter. It could have been such a great company, and really it's an incredible failure. And Musk came along and he didn't bang in the last nail of the coffin. He put about 75% of the nails into it, I'd say, maybe more. Disastrous story, but like I say, I came out of it feeling sorry for him.
Do you think it will recover, Twitter?
The fact that you can get rid of so many staff and the users just carry on because there weren't any alternatives at the time the book was written. There's threads now, and a lot of people have migrated to it. But there's still a lot of people on Twitter, but the advertising is just non-existent. I mean, it's so horrifically bad because it turns out advertisers don't want to be associated with racists and misogyny and political extremism for some odd reason. Who would have thought it? So it's sort of very, what would I call it, shallow view of what freedom of expression means has just ruined that business. So it's a good read, Breaking Twitter. Thanks very much for your time, everybody. Thanks for listening. Graham, thank you for editing my story. It's going up on Friday. Apologies for us having to do it again. Gus, looking forward to working with you next week on, what are you researching next, Gus?
The next one. So the thing that I'm just wrapping up at the moment that's been really quite interesting is looking at the funeral industry and at the New Zealand Stock Exchange. So
they go hand in hand.
Yeah.
They go hand in hand.
Yes, that's right. That's right. There we go. Okay, there's something to look forward to, everybody. Okay, thanks for your time. See ya.